I'm Nick DiNato, and I'm from New York.
I'm Jacob Taylor, and I'm from Western Oregon.
I'm Jeffrey Barczett. I'm from Old Oregon.
And I'm Harrison Ryan. I'm from Portland, Oregon. Thank you all for hiring us as outside consultants in determining the value and weighing the outstanding offers of Express Auto. As you all know, Express Auto is a privately owned dealership started by John Thompson with operations in the United States as well as European operations in Italy, France, and Germany. Upon his death, John transferred 50% ownership to his wife Sarah, 25% to his son Todd, and 25% to his daughter Shauna. Sarah and Shauna are both not involved in the day-to-day operations of Express Auto and would like to liquidate their ownership to pursue business opportunities in Paris. As you all know as well, Todd has worked at Express Auto since his graduation from college and has created meaningful relationships with the managers in European and U.S. operations. Express Auto sells only Fontaine Motors, the renowned high-end luxury cars compared with Audi and BMW. There are currently 2 offers on the table to purchase some or all of the operations of Express Auto. These offers have gone through the sometimes difficult process of being approved by Fontaine Motors. Fontaine Motors is known to scrutinize these offers to protect brand image. Hoyt Partners, a New York-based investment firm, has made a $173 million offer to purchase the combined operations. This offer would replace Todd in management and is not favored by him. Europcar, the European Automobile Network, believes they can increase the operating efficiencies of Express Auto's European operations, and they have made a $73 million offer for the European operations. Todd and other managers are in fear of getting replaced following a sale. Todd has proposed a dividend recapitalization of $55 million. This recapitalization would act as a cash payment to Shauna and Sarah. They would both get the liquidity they need, and Todd would be able to keep his position in management. There are concerns that this offer would put strain and unnecessary leverage on the dealership. We recommend that management accepts Europcar's offer. As we will touch on later, this is the best option for all parties involved. To weigh the feasibility of these offers, we will start with a valuation of the U.S. operations. I'm going to start us with an overview, then we'll do a valuation, and finally a conclusion. Here's my slide. Apologize. I'm missing my sentence. Oh, there we go. Sorry. When doing evaluation, it's important to keep time and context. We have been given 2-year historical financials and current estimates for 2012 and given 5-year projections until 2017. Currently, the U.S. is still recovering from a recession and has an average growth rate of 2.4% that is forecasted into 2015. The unemployment rate, which is inversely related to auto sales, is at 8% and falling. The U.S. inflation is expected to meet the Fed's target of 2% for this year. The auto industry outlook grew at a rate of 10.7% from 2010 to 2011 and is projected to grow 5% a year until 2017. Right now, the market for dealership acquisitions is red hot and it's only expected to grow. Acquisitions are at an all-time high, and for the first time ever, there were over $1 billion spent on acquisitions last year from 2010 to 2011. It's expected to grow 8% this year and another 12% into next year.
Okay, now I'm going to present our estimated enterprise value for the U.S. operations derived from income approach. Okay, here we have Express Auto's actuals and projections for sales. These are our own projections, which have higher growth than management projected. The reasons for doing this is we thought that their projections were a little conservative, and in the past they had really strong growth. We thought that their projections didn't reflect their past as well as it should have, so we also there's an expected increase in U.S. sales for the industry. So now if we look at the numbers, the 2012 estimated end-of-year sales are at $400 million, and with the compounded annual growth rate of 5.32%, there will be projected 2018 sales of above $500 million. Here we have the projected expenses for Express Auto. For the most part, they grow with revenue. COGS and personnel expenses grow 2% slower than revenue. Depreciation and other expenses grow at the same rate as revenue. And then now if we look at the numbers, the 2012 estimated end-of-year expenses are 400 million, and the 2018 are above 500 million. And with these expenses, we incorporated a rent expense. The rent expense is hypothetical. This is to avoid overestimating the value of operations. For this number, we use 9% of gross profit. This is an average among dealerships in the industry. Here we have the projected free cash flow valuations. The estimated 2012 end-of-year value is around 4.5 million. And we will use these projections to calculate the value of Express Auto later on. Now leading into discount rate, we use a build-up method, which gave us cost of equity of 14.91% and an overall WACC of 9.96%. Continuing with the discount rate, we found comparable companies' WACCs in the industry of 8.8%, and the WACC we calculated using a build-up method of 9.96%, which averaged out to be 9.38%. So income approach using DCF. We calculated an enterprise value of 88 million. This value was calculated finding the present value of the DCF and adding the terminal value, and then also adding back the $6.2 million worth of real estate. Continuing with income approach, looking at the value range. Here we have a value range for income approach. There are 3 WACC options that we considered, one from the comparables, one that we calculated, and the center column is the average that we used. And then on the left side of the screen, we have long-term growth rates we also considered from 2 to 3, and we ended up going with the 2.5% long-term growth. This is based on growth in the industry and economically. This gave us, again, a value of 88 million. Now going on to our estimated enterprise value for the U.S. operations derived from a market approach. So some of the guideline public company criteria we used were similar franchise ranges, geographic placement, and similar margins. So based off these criteria, we found 5 comparable companies. You can see that Express Auto ranks below all 5 of them in both EBITDA and EBITDA margins categories. Because they are so low, with a $9.6 million EBITDA and a 2.24% EBITDA margin, we put them in the 25th percentile, which gives them a 9.4 multiple. So with this 9.4 multiple and an EBITDA of 9.6 million, we get an enterprise value of 90 million.
We will now move over to estimate the enterprise value derived from a Blue Sky approach. So the Blue Sky value is essentially built on 2 elements or components, the net adjusted tangible asset and the goodwill of the business. The net adjusted tangible asset is the tangible asset, and then we subtract the total liabilities. And the adjustments is for market value, excess of book value of the real estate. And then we also have some LIFO reserves that we add back because the US operations are using a LIFO basis accounting. For the goodwill value of the business, we use a pre-tax income, and we multiply that with a multiple. We'll use a pre-tax income of EBIT, projected EBIT from 2013, which we think is the most reliable earnings estimate for Express Auto. Here are some key drivers for a Blue Sky multiple. This will essentially yield a higher or a lower multiple. So we have earnings growth expectations, we have buyer demand, we have the value of the real estate, market vehicle preference, and operating margin. And here we have Blue Sky multiples for similar vehicles as Fontaine Motors. They yield from a multiple of 7.5 to 5. We believe Fontaine is going to be valued at a multiple of between 4.5 and 6.5. And then we believe for the US operation that the multiple is going to be on the higher end of this range. We believe so because it has been a high demand for acquiring private dealerships in the US and is expected to grow further into the future. This slide is not changed. Okay, it should be high expected operating margins, which is based on our projections, and we also projected sales to grow more than the industry in the US, which will drive up the multiple. The value of the real estate is also 6.2 million above the book value of the real estate, which also drives up the multiple. So using a pre-tax income, which is EBIT 2013 of 8.3 million, and apply a multiple of 6, we get a goodwill value of a business, or a blue sky value of 50 million. Then we add the net adjusted tangible asset of 36 million, which gives us to an estimated enterprise value of 85.3 million. Here we have a value range, or a sensitivity analysis using a different multiple. So we have used a range of 5.5 to 6.5 blue sky multiple, which yields a value of between 89 to 81 million. Here we have a value summary of our 3 valuation metrics, or valuation methods that we used: an income approach, market approach, and blue sky approach. They yield from a value of 95 to 81 million. We believe the value for Express Auto to be, for US operations, 85 million. Moving over to valuing the European operations, we'll first give an overview of the economy in Europe and the industry. Then we will conduct our own valuations, and then we will get back to a conclusion. So, economic outlook. The GDP, annual GDP growth rate from 2012 to 2015 is expected to be 2.4% for the US, and it's slightly lower for EU, about 1.1%. This is mostly due to the European debt crisis that happened 3 years ago, that we are still in. That I'll also talk about that more later. The industry outlook. On the right side, you can see a graph, which is European car sales in millions in Europe. You can see from 2010 to 2011, that number grew by about 5%. It also had a sharp, or it's expected to have a sharp fall from 2015 to an estimated number in 2012. We are also, it's also projected that car sales in Europe is going to grow from 2012 to 2017 of about 2.15% annually. Here we have the European debt crisis. These are the 3 countries we operate in, or Express Auto operate in. It's Italy, Germany, and France. Currently in Italy, public debt to GDP is 130%. We have home sales are dropping, and we also have, people in Italy is struggling to pay off their personal debt. In Germany, GDP is contracting, and we also see a decrease in exports. We also witnesses a fall in exports in France, and they struggle to compete against neighbor countries in Europe and Asian countries due to high production cost. This essentially translates to a decrease in consumer spending, especially on vehicles, and especially on luxury vehicles like Fontaine Motors.
Alright, with those factors in mind, I will be taking you through our estimated value derived from an income approach. So the first thing we wanted to do was adjust management sales projections. We feel that they've been a bit optimistic, especially given the economic environment they're operating within. So we changed it to a compound annual growth rate of 3.31%, which is just down a little bit from management projections. Next, we adjusted our expenses. In the manner in which we adjusted our expenses mirrors that of our US adjustments, or that we simply added back in a theoretical rent expense. We took these and factored in all of the adjustments to arrive at a free cash flow number, so that we have some amount to discount back to find the true value of the company. But before we talk about discount rates, or what to use for a discount rate, one important consideration that we felt needed to be addressed was the amount of risk associated with each respective country and operating within them. So for our purposes, we'll be using Professor Damodaran's country risk premium spreadsheet, which is published annually. But before we use the country risk premium, it's important to understand how it's calculated so that you understand what it is that we're factoring into our valuation. The country risk premium is typically understood to be the default spread between the sovereign debt. Simply put, this is the spread between the yields of the sovereign debt and risk-free debt. And one example of risk-free debt would be a treasury bill in the US markets. So we took each of the corresponding country risk premiums and we held the US as a base, or so we decided to see, or we wanted to see how far and above each of our respective countries in the EU were above the US country risk premium. So for example, Germany has a 0%, that's because it has the same country risk premium as the US, and Italy has 2.63%, meaning that it's 2.63% above the US's. We then took the average of these numbers and factored them into the equity risk premium, part of our build-up method for cost of equity. Here you'll see that the equity risk premium found on the left in the second from the top has a 6.8, which is above what we had for the US, and that's simply reflecting the addition of the country risk premium being factored in. So with that plugged in, we arrive at a cost of equity of about 18%, which when plugged into our WACC calculation gives us a WACC of 12.04%, which is a fairly steep discount rate, especially when compared to our guideline public companies who have a WACC of about 9.3%. So we then decided to take the average of our 12% WACC and their 9.3% WACC to arrive at a WACC of 10.69%. This discount rate applied to our free cash flow figures gives us a present value of 13 million, a terminal value of 33 million, and then we added back the market value of the real estate, which was around 11 million, giving us a total enterprise value of 56 million. We then conducted a sensitivity analysis or a value range to see the effect on the value with a change in discount rate and or long-term growth. As you can see, there is a fair amount of sensitivity here, but for our purposes, we will remain using the 10.69% WACC found in the middle and the 2.5% long-term growth found in the left in the middle, giving us the same value, the 55.8. I'll now walk you through our estimated value derived from a market approach. When conducting a market valuation, it's important to have some criteria in place so that you know that your companies are truly comparable. For us, the three main criteria were that they operate within a similar franchise range, a similar geographic location, and that they had similar margins. And when we conducted this analysis, this comparison, we found that Express Auto landed right about in the middle with an EBITDA of 7.1 million and an EBIT margin of 3.16%. This means that they are right in the median percentile and therefore receive a multiple of 9.3. When we apply this 9.3 market multiple to our EBITDA figure of 6.6 million, we arrive at an enterprise value of 61 million.
We'll now move on to our estimated value. We'll now move on to our Blue Sky valuations for the EU operations. To calculate the Blue Sky, we use the same calculations as before, with a couple of exceptions. Since the EU operations use a FIFO basis, as do most public companies, we only adjusted tangible asset value to the excess market value of real estate. And for the goodwill, we also adjusted for the potential synergies that Europcar might offer. As discussed before, the multiple range for Fontaine Motors dealerships is around 4.5 to 6.5. And in the EU operations, we have two key drivers that are increasing the multiple. We have high real estate value at 10 million over book value, and we have low operating margins, which due to the franchisor licensing agreement drive up the multiple due to it being a prime investment option. For the other three key drivers, they're pointing towards a lower multiple. we have low expected earnings growth at around only 3% annually. And due to the debt crisis, we're seeing decreased consumer and corporate spending, which is decreasing buyer demand and shifting the market vehicle preference towards more affordable options. Thus, we believe that the blue sky multiple would be around 5. And with the pre-tax income, with adjustments of 5 million, and with the 5 times multiple, we arrive to a goodwill value of 25.3. And then added with the net adjusted tangible assets of 34.2, we come up with an enterprise value of 59.5. And we conducted a sensitivity analysis to see how much the multiple changes the enterprise value. We used the multiple range from 4.5 to 5.5, which gave us a gap of around 5 million between the values. And where we believe the true value of the company lies is around 60 million. Here we have a value summary showing all 3 approaches with the corresponding value ranges. The values range from around 52 million to 68 million. And with the offer from Eurocard at 75 million, the value ranges are far below the offer. And where we believe the true value is around 60 million, which gives the Eurocard offer a 25% premium. Now we'll move on to the valuation of the whole entity. We'll start with a brief overview, then move on to our valuation, and finish this presentation with our proposal. So in overall, the European debt crisis has brought instability in the European economies we operate in. And in the near future, we're going to be only experiencing very low growth at around 1.1%. But in the US, we've already come out of the recession, and we're experiencing fairly strong growth. And we have fairly strong growth forecasted for the next few years at around 2.5%. For the industry growth, we have pretty similar growth for both areas, but with the decreased consumer spending and the shift in market vehicle preference, the portion of luxury car sales is dropping, which is hurting our operations. And here we have a value range for the whole company with the 3 different approaches. And the values range from around 130 to a bit above 160 million. All of these values are still below the 173 million offer from Hoyt Partners. And where we believe the true value lies is around 145 million, which gives the offer a 19% premium. We propose Express Auto to accept Eurocard's offer since it has a higher premium and it's the best option for all shareholders. Todd gets to keep running the US operations. The company doesn't have to take as much debt to pay out Shauna and Sarah with the dividend recapitalization. And for what comes to Shauna and Sarah, if we take out the offer of 75 million, subtract debt and add back cash, we come up with an equity value of 36.6, of which Shauna and Sarah are entitled to 27.5 million, which is still far below the 41 million they are seeking to start their business in Paris. So in addition, we propose, we propose that Todd uses his gain of 9.1 million from the sale to purchase shares from Shauna and Sarah, and we also propose the company to perform a leverage buyback of around 4.4 million to reach the 41 million benchmark. This would shift the company's equity structure so that Shauna and Sarah would have an ownership for 47%, Todd would be at 44%, and the company would own 9%. In conclusion, we believe that this option fits all shareholders' needs, and we recommend this route for Eurocard, no Express Auto. Thank you.
Give him a hand. Michael, you want to lead us out?
Break. Could you give
Could you critique
Yes,
us
yeah, gentlemen,
specifically?
so I'm recording this, so you'll have access to the video. These 2 guys have another commitment that they need to flesh out. Before you walk out though, clearly that you took some of the input from Jeff and myself the other day and have incorporated that here. I don't know how much of it's the two of you versus the three of you, but that was very obvious, and nicely done, honestly.
Well done.
Okay, all right, do what you need to do. Thank you.
Great, I agree. Huge improvement to last time. Great work. I love it. You spoke super well this time. Keep it up. Very good job. I think when we started, I just like when, I think it's important, right? Industry, the economy, it's relevant, but tied to how it influences, right? Like, okay, the unemployment rate is falling, this is rising. Tell me why that matters to me. I think you did it on the last one, but you want to say, well, because this is happening, we chose lower, or like it influenced the selection of our growth rate of our discrete period. Like, how does it tie to the valuation, right? I like to see that. I think the graphs still need a lot of work, like that there's decimals and like it's just not very standardized and
Yeah,
consistent.
it's not consistent.
I like the football fields, right? They're fancy, they look cool. But you want to make sure that the other ones with the graphs, with the line graphs and everything like that, that is consistent and that actually like looks good. Because right, like there's a huge thing. It's hard to read all the words when there's a lot of words, and I think that's great too. Big font, not too many words. I can read most things, but when you put a graph on there, I'm going to look at it, and if it's just ugly, it's just going to be But if it's good, a good graph can make a big difference.
You guys separated all your footballs though, didn't you? You no longer have them combined. It was a big visual benefit.
So someone said cogs are growing at like 2% less.
That was
It was Jacob, yeah.
Yeah, but my question would be like, why, right? I think it's just the same argument I make in the industry and economic outlook. Just add because, just give us a reason,
Well, is that part of the outlook, or was that part of observation of this firm?
Part of the observation.
That's what I thought. So say, we have observed that. Okay.
Well,
I think
yeah,
that's
exactly.
Yeah.
That's overall.
Based on historical trends, because we've observed it over the last few years, you've made improvement to your costs. Right, that's a great reason, and it doesn't leave me wondering. Can you go back to the multiples, the U.S. operations? I remember you saying were they like low, and you chose like a 25th percentile. You don't need to choose. You can go. I think
For the
it's-
US.
Oh yeah. This was perfect, right? Like, they're super. Is that the median?
That's European one.
Oh, yeah, go back to the U.S. There you chose a median because they kind of fit in there. But I felt, if I remember correctly, the U.S. said it was like low.
Yeah.
Here. Where is that? Somewhere you chose the 25th percent. Is that here?
Yeah,
that's the one.
Okay. Right, like their EBITDA is so below anything on there, and their EBITDA margin 2 is way below. You can choose a multiple that's lower than what's on there, right? If they underperform on everything, you can be like, the lowest multiple is 9.4. However, because they underperform EBITDA and EBITDA margin, we chose lower. Like, don't feel like the range restricts you to the range. You could say, look, this is the range. However, we underperform on EBITDA margin. Therefore, I don't think we fall a bit below this range, and we're smaller, or right? Like, not only the EBITDA margin is smaller, but also our EBITDA in general, like, we're just a smaller company.
Oh.
One part that we forgot to talk about on this is how the franchisor licensing agreement plays into it. If you have low operating margins, it actually drives up the multiple because there's so high barriers of entry into the industry. So, like low performing low performing dealerships are in high demand, because there's so much improvement.
It's like one of the main ways to get into the industry.
Yeah, and you can even see on this graphic that the lesser performing companies typically tend to have higher multiples. So Michael, what I think the inference here is you need to hear what Michael's saying, in that in and of itself, that might suggest a multiple less than the 9.3, but because of what you're now referencing, you brought it back up too. So that you respect the question and deal with it.
Right, that's a great reason. Members of the board, you see we're underperforming in EBITDA and EBITDA margin. However, an interesting dynamic in this industry is that people are willing to pay a premium. Therefore, we chose to go on the low end. You chose the lowest, right? You didn't choose the 25th percentile, which might coincidentally, because there's not that many transactions, be the 25th percentile, but you chose effectively 9.4. And give that reason. I think on the WACC calculation,
Can you,
I just-
before you switch sides, just, you're displaying 1 decimal versus no decimal points versus the 75th percentile as 2 decimals, and so on and so forth. Just make note of that, standardize that.
And it took me a second to realize that 25th median and 75th percentile are not more company names, right? Because maybe even make space or
Between Express Auto and.
Bigger line, yeah.
And then before I move to a different slide, because we were just talking about the adjustments to expenses. In our previous presentation, I think, Rick, you missed when Jake went through his adjustments. And so then when I said that I did the same adjustments, you actually didn't catch any of it, right?
Okay?
Did you guys feel like that this time, or did you catch the adjustments, or should I reiterate them on my slide?
no.
And you're referring
I'm
to
not
which
quite sure
adjustments
what we're
now? Are you talking about the rent?
Expenses. Yes, so
Yeah.
rent is one of them.
Yeah, I had questions last time. I didn't have questions this time about that.
Okay.
Okay. On the WACC, can we go to that slide?
For which one?
I think the first one. Yeah, this one. So we come up with I just think what I want to get at is that I think it's actually the next slide where we weight. Yeah, where we say, here's the WACC we come up with for our company. Here's the WACC of comparable companies in the same industry, and then we weight it. Like, I don't know why we do that. Why not just use what we come up with, which I think is already fairly low, but that's a matter of opinion. But I don't understand why we weight these two things, because one is specific to a company. It has maybe with some sort of company-specific risk premium, where it's for us, and then we take something else, right? Like, what's the reason behind weighting something that's observed from other companies?
So how would you, if that question were asked of you, how would you answer it? Or what would you say in your presentation to keep it from being asked? Okay, so you want to have an answer to it, right? And so you're either going to do what Michael's suggesting here, and that's eliminate the thing that's problematic to him, or come up with something that causes us not to be worried about it.
Those are the comments I had.
Fair?
Yeah, good job. Your speech pattern much clearer. You fell into it a couple times, but honestly, like, it was well done. But you know, hope you guys it's the same boat. As a board member, I appreciate you guys walking us through this. One of the things that you mentioned early on, and it might have been two of your members that left, but the acquisition growth has been increasing over time. Is there any reason for us to maybe wait and contemplate if acquisitions are going to keep going up and your projections have us growing and valuation is based off of multiples, would we not possibly get more money in 2 years if we waited for that growth sector to continue?
So that comes back to, I think, ownership, and Shauna and Sarah both want to exit the industry as soon as they can, so they can start their business in Paris. So I think waiting an extra year or two may not be applicable to them.
Gotcha. And could we, I mean, like, would there be another way to possibly increase the portion at the end that you were talking about where, you know, we could get them some liquidity and still hold on to as much equity as possible of the company, or is it a pretty good time?
I think the way that we did it, we sort of maintained as much equity as possible in the business. Being that Shauna and Sarah need $55 million at least in order for them to not just do an entire dividend recapitalization. Yeah, I think that's the best way to do it.
The projections, you know, we were as a board not a part of creating the projections. I think you mentioned that you believe that the US projections were somewhat conservative and the EU projections were somewhat optimistic, and you had kind of differing things. What is our management missing? Why are they conservative in the US and optimistic in the EU?
I think
especially for European operations, that they think they operate in Italy, Germany, and France. That since they are in the European debt crisis, that they will recover faster than we suspect they will. And we have seen consumer spending is decreasing, and we believe their projection is too optimistic for what we see in the industry and the economy.
Gotcha. Solid answer. I'd accept that.
Yeah.
I'll let the other go, but honestly, I think Rick made a good point that a lot of the speech components of explaining your analysis left me without wondering a ton of questions, and I don't know if that was, I'm hoping that was by design, but that was my view on it. Was a lot of the questions that came up in my head got answered in the presentation, either on the slide that they came up in or down the road. So however you guys structured it, I thought was very, very well done.
Regarding the adjustments, I forget who was speaking, but on the rent expense, you go right into talking about, was it clear that it was made that you guys, that the subject company owns the real estate and therefore you made an adjustment? Was that a talking point? For some reason I missed it.
I don't think it was super clear.
Because it's early.
Yeah, I think we just we said that we included the rent expense so as to not overvalue the market value of real estate, which I guess doesn't necessarily mean that we own it.
It's a strength in the dotted line.
Yeah.
Just keep.
Lastly, how did they do on time? Because my only other talking points are kind of regarding the structure of your guys' proposal, taking more time to expand on that. So I was curious how.
Pretty close.
Pretty dang close.
Yeah, you had maybe a minute-ish, but if you're a couple of minutes over, nobody's bringing out the hook, right? You go much further than that, and they're going to either stop you or they're going to discount you. So, but you're pretty close to being there.
And then, can you go to the proposal slides?
Some of that'll be sped up, but the other two are not
Read
really.
the script.
In the moment, so to speak,
Yeah.
Yep.
they're used to you guys now, right?
I know this is brutal to have to rip through all these. Okay. Perfect. Yeah, right. So, thank you for breaking out, coming to an equity value.
Yeah.
It's just that, at least we can understand kind of where the actual value is going to be distributed to shareholders. What I'm talking about is the stock buyback program. You had a slide in which the company maintained a 9% position.
With the graph, yeah.
Yeah, with the graph. From my understanding of a stock buyback program, those shares would inadvertently be retired to a treasury and therefore would not actually be
Yeah,
outstanding.
you got something going on there that's foreign.
Yeah. So that 9% would go bye-bye in an actual stock buyback program. So the share prices then would increase, but the percent ownership.
Yeah, so your 47 and 44% ownerships are gonna both go up proportionately, splitting that 9% that's gone into the treasury. So you're gonna get them awfully close to 50-50, right? Is it problematically close to 50-50?
Where there's no distinction in who has a controlling position.
Maybe. You gotta think about that. Who sides or allies with whom? And maybe you make representation of that. But I understood your proposal. I got what you were trying to accomplish here.
So
Yeah,
I
I
think,
thought it was original. I thought it was creative. I liked it. But I think that's a good point, right? If Sean and Sarah still have a majority position in the company they don't want to be involved in, their interests may no longer align with the best interest of the company, and they have control of the company. I think that is a concern.
It's not clear to me that these numbers that you're representing for the buyback and such are properly affecting the share percentages. We'll take a real close look at that, maybe even work on it with me a little bit just to satisfy my curiosity that it's done right, okay? It probably is, but let's find a few minutes between here and there and make sure that it is.
No.
Gentlemen, you had very little opportunity to say anything in the prior presentation because of time. Anything you guys want to add? I've only got one or two things that I want to give to this, but anything you guys want to add that hasn't been said yet?
Well, I thought you guys did a really good job of explaining everything. Like, definitely, there was only maybe like 1 or 2 points. There was like a little bit of a hiccup, but I felt like the communication was very good. One thing that like always gets to me is like I have like a keen eye on like attention to detail. So I think as far as like your guys' posture, the way you guys stand, you need to have like straight backs. You can't have your hands in your pockets. You guys need to be like dressed the same. So whether you're gonna go ties or not, I know like it's a little different. Like with that respect, as far as like the focus on the room, whoever's speaking at that time, the focus needs to be on that person. So you guys can't be wandering. You can't be looking up and down. You need to be focusing on that person. And everybody else in the room will gravitate towards that person. They're the most important person in the room at that time. So like that's very important. I saw a lot of formatting errors. They're really small, but they like really stick out to me like a sore thumb. We already mentioned a lot of those as far as like decimals, maybe like font size. We could be a little bit more consistent there. Some of the margins, or I guess like the y-axis, for example, we have like a lot of values there going down. We could simplify things, just clean things up a little bit. I really do like the football range that you guys had displayed there, but let's like add a high-low and then average value to that, because you start speaking out numbers. I don't really know where those are coming from, but you have a great chart, right? But let's just throw in some high-low there. Yeah, I had one thing that really stood out.
Before you move off of that, one of the great ways of accomplishing that is the person that's got the clicker is speaking. You know when you're saying hi, you can just go ahead and instead of it being part of the permanent graphic, you can click and let animation bring it up and let us see it there. And then click and that one went away and the next one's there. That might be a good way to accomplish that, but I think that's a really good point, Bo.
Yeah, so that was good. Again, these are like really small things, and I think like the content is like very well drilled here. Like it does come down to a lot of formatting, as far as like some of like the estimates. You guys have like you're using like we literally have like 2018 like E for estimate, and then you have like 2019 P like projection. Just like inconsistency there. It's just I don't know. It needs to be cleaned up a little bit. Yeah, you guys could obviously increase the font size. We talked about that. Number 17, slide number 17, we have like the comparable companies that we're looking at. You guys, just off the top of the head, you like know how many companies you're comparing this to, right? Do you have like the number of comps that you had? I don't know, it was on slide 17, I forget the content there, but looking at the peers. This is tough. So anyways, it's just like for a matter of like, okay, did you only look at like 2 peers, or did you look at 20 peers? Like, why did you choose like this peer range? You know, like that kind of like indicates like the industry. I don't have a whole lot of background here, so I don't know. But one question, you know, like why this like why these peers? Again, cleaning tables, a lot of that stuff. I did have a question on like 56. So those are like the high-low. Just like the high-low football fields, right? You show like, okay, we have like the value here, here, and here, and then you just like throw your like target price out there. I don't know if you guys are taking an average of these 3 valuation methods, or like what the weighting came into play there, or,
We're not really weighting that much. We're mostly going off with the blue sky valuation since it's the most common used.
okay.
Yeah, so rather than represent weights to us, you show us your ranges and say, you've chosen a number that fits nicely within the ranges.
Yeah.
Yeah. And I think that was actually a direct recommendation Pickett had, right?
Yeah.
I
Okay.
actually thought that was like, don't give me the weightings to like pick apart.
Yeah, right.
Like I thought about that, I was like,
Yeah.
Yeah, I think they hit a lot of my points.
For me, I think that the explanation and why, for example, where sales growth was going up could have been a little bit better. I also think that you guys had a little bit of inconsistency when it came to like speech and speed. There was several times where I was trying to read what you had on the slide, but you already skipped to the next slide by the time I got to the middle of it. So I'd say just take a minute to like maybe slow it down. I know we were cutting it a little bit short, but maybe like put less verbiage and put more images, I don't know, and clean it up a little bit in that sense. And specifically that happened in slide 41. That just had a lot of content when you were, I think, going over the blue sky method, and someone from, like, I've never heard of the blue sky method or how you would use it. So if you're going to put words on there, I would say just take a minute to really like break it down and just slow it down a bit, so that way I can read all the content that goes in behind it. Yeah, I would also say just more of an explanation. And is there any, like, and again, since I'm not super familiar with the blue sky method, like as far as technical wise, do they have like a historic like multiples? Because I know they come out like every year of that year. Is that correct? Or how do they go about determining the multiples on the blue sky method? When do they get published, I guess?
So blues are published by a couple of different data repositories on a quarterly basis.
Okay.
And I think they're only accessible free on a year-end basis, right? Yeah. So, but they're available, and we've got some of those that were given to us.
Okay.
And then, but I thought you did a pretty good job of helping us understand the technicals there, and the people in the room that day are going to be pretty savvy to them.
Okay.
Like some of the backup material on the case gave us explanation of those things.
Perfect.
I couldn't see that there were numbers on the slides. I was like, are y'all just savants and like counting slides?
Yeah, they were standing in front of the numbers.
41, all right.
Okay. Tucker and Hayden, anything you want to add here?
I don't know, basically like everything I had is kind of already said.
Okay.
I was thinking like, we're talking about like the car sales projections and like the economy projections, like do you kind of say like later that like you base it off that, but I feel like maybe like when you're first showing those slides, like talk about like why you're showing it, kind of like saying this can be like influence like your projections for the future, so that way you can kind of understand like more why you're seeing it right then.
Anything, Hayden?
I mean, some of the advice that I had I sent to you guys earlier, maybe just didn't have time to incorporate it with the smaller detail stuff that spoke to the consistency of your presentation. But also, presentation-wise, it seemed like sometimes when you were sort of like highlighting what's going on in your charts, some of you would start with like the most like recent, like your projected periods and read backwards. And others of you would start with like historical years and read forwards. And like, I think like obviously with repetition you'll get some of your framing down and your argument will sound a little more coherent, but I mean, that just definitely stood out a little bit to me.
One more comment, just
Please.
real quick. Just the way you guys like answer questions, don't use words like I think or like this is what I believe. It's like we believe this, or like you have to be more consistent that way. It's not like a one-man show. Just something to keep in mind as you answer questions to the judges.
Yeah, so cohesiveness there, right? But again, we're paying you a lot of money, so you can be very confident about it too. So the final comment I'd have for you in this group, and then I want to talk to you privately before you leave tonight, the four of us, briefly. Jeppe, you have kind of a clipped way of speaking. You speak in very short syllables, and it's concise, and it worked really well with the cadence of this presentation tonight. You typically use it to your advantage, but it worked really well with that. Nick, your speaking is a little bit more comfortable, casual. Your cadence works well, but I need a little bit more volume out of you, so that you exude the same level of confidence, and so we can kind of balance these things. And finally, Niklas, you're a really smart guy in a room that, frankly, and I'm not just being egotistical, a room full of some pretty smart guys tonight. Be confident. You're a little uncomfortable tonight, more so than I expected you to be after this many presentations. You're a really smart guy in a room full of otherwise smart guys. Be confident, okay? You've got it going on. And if I could just take a little bit of the lack of comfort out of your voice, I mean, it would improve things rather a lot for you. But in terms of what you guys provided tonight, including Harrison and Jacob, given the challenges they've had in the last few days, nicely responsive to the input given to you by Jeff and myself, 4 days ago? So you've made some very quick turnarounds in this. Nicely done. Okay.
I think to Bo's comment that you will be asked questions, and not only do you have to say we, but when the question is specific to what someone did, right, you want to be able to, you don't want to say, oh, this is what this person did, or this is what that person did. You want to come off as a team, and I think in college it's more so the case where like this was this person's, like
Yes.
that's what they're going to be graded on. But you're hired as a firm, you're hired as a team, and you got to have each other's back even if there's a mistake. You can't like kind of, right, like if there's a hole or if someone says, well, this was this person, it's like you're there as one unit, and if someone cracks, that everything just goes, right? Like it's not like, well, we still look good.
Well, and if you have any lack of comfort in representing someone else's analysis or position, then rather than answer the question for them, turn the question to them. Let them answer it.
Yeah.
But he's right. So, I mean, you guys get individual grades in classes, but do you think that when we wrote that big check for the consulting fee for your firm, that because of this, you're going to determine, well, so much of it goes to Jepa, so much of it goes to Nick? No, we know that's not going on. So you got to show a big united front.
Have some fun with it. I mean, it's like clients ask me questions all the time. I'm like, yeah, that's a great question. And we discuss it as a team, and I played this side, and so-and-so played this side. There's no team, right? Like I signed it, but like, they hired you. They want to know that it was well thought out, and ultimately the team decided that we felt this way, and that's why we performed it in this manner. So, the question part is where your personalities and the culture of whatever company you are comes out and sets you apart, I think.
Yeah.
Okay, nicely done.
Well
Give him a
done,
hand.
guys.